Good morning. This is George Kachuk with RCM Wealth Advisors reporting you from the CME Group trading floor in Chicago. This morning I'd like to talk about the equity markets. Well, the equity market continues in a strong uptrend. S&P is doing very fine. NASDAQ, we did see some heavy selling last week on the NASDAQ over the last 2 weeks. We got about 4 days of heavy selling. However, Thursday we saw a nice recovery in the NASDAQ where it moved higher on really strong volume. We'll call it an accumulation day. Actually, both the NASDAQ and the S&P is what they're doing right now is just kind of consolidating a little bit. You know, we've gone a long distance off that June 24th bottom, so it's only natural for the markets to pretty much just consolidate a little bit before they continue upwards. That's to be seen. Earnings continues this week. We have a Fed meeting this week. We have a GDP number. We have a jobs report number. So there'll be a lot of headlines gyrating the market back and forth. However, all the action appears to be pretty constructive. The reason I say this, a lot of leading stocks, we saw some gap ups last week on earnings, and they were able to hold these gaps and even move higher. We saw a lot of that in the biotech sector coming from Celgene, Gilead, Biogen. We continue to see banks doing very well. If you look at the financial sector, the XLF is still doing very well. The healthcare sector, XLV is doing very well. Consumer discretionary, XLY is doing very well. The technology sector, XLK, reclaimed its 50-day moving average, started to improve. That was one sector that's a little bit lagging. And the semiconductors also took a bit of a hit, came down to their 50-day moving average. But generally, those are all acting pretty strong, as are in the industrials. Now, the home building sector, if you look at the ETF, the XHB, that's lagging a little bit. And even though we keep getting good housing data, that sector is not doing very well. So we'll see what develops there. So anyways, going forward, we do have a play for you today. And I'm looking at Facebook. The symbol is FB. Now, if you remember Facebook, it was the most loved stock before it went IPO. And after the IPO, it became the most hated stock. And of course, the market was waiting for how is Facebook, are they going to be able to monetize mobile ads? Well, last Thursday, they reported earnings. And what we saw was a 75% increase in ad sales. In the second quarter, we saw a 58% increase in earnings, a 53% increase in revenues. That got the street very excited. We had a huge gap up. Facebook moved up 31% on 366 million shares traded just that day on Thursday. That was the second highest day that we've seen that kind of volume since the IPO, except the IPO was pretty much a bummer and a down day. So Facebook right now to me is a buyable gap up. So if you're going to play it, you can play it to about $35. It's trading just below that right now. Now use the low of the gap up on Thursday, $32.75 as your stop. But if the market comes in a little, you could give it a little porosity, meaning 1 or 2%. So, you know, your stop should be maybe somewhere above $32, $32.30, $32.40, $32.75, depending on the size that you buy. Remember last week we talked about position sizing, so you don't want any of your one trade to be more than a 1% loss to your portfolio. So you want to size accordingly, and it should hold the gap if the trade's going to work. If it doesn't hold the gap, the trade might not work. Another thing to know too about Facebook is last September you had about 700 funds in it. That numbers are about 1,200 funds. And you have some really good quality fund managers holding Facebook. So the future looks pretty good. Of course, we'll see. As always, let price and volume be your guide. This is George Kachuk of RCM Wealth Advisors reporting you from the CME Group trading floor, and have a great trading day. Thank you.